other people, let's say in our scenario, that are able to help me. The one in my room and the one in the other room that I have a union with, which means I can also rely on them. But there is also another side for such connection. If I have a good connection with you and we have a simple, let's say, one wallet between ourselves, room one is going to benefit very good from this because they are in the same condition and the same room. And this means that, just like I said, more capital for them, more margin for them, and they can even use the money in the other room. But at the same time, if room one is doing very well and room two is not doing very well, it means they will also share the issues between themselves. So if room two is having, let's say, bad trading conditions, prices are not going well, there is not much stability in the other room, this means it's going to affect me as well because we share the same wallet. So to make it short, it's good to have such a wallet, but you should also have somewhat freedom for yourself. If you have fully, let's say, one wallet share between everyone or one currency between all of the countries, it means you cannot make one size fits all. Your issues are my issues are your issues. If I have something bad, it's going to affect the others. But at the same time, I should make sure that I could, let's say, do damage control as much as possible and prepare for such union before I start with it.
Thank you so much,
Thank you.
Mr. Andraus. Mr. Jamil, what lessons can be learned from the Eurozone experience?
Thank you, Elsa. So this topic, it's a very academic topic as well, because what we have to take into account is, firstly, some of the criticisms that come into the Eurozone is due to some of the individual opinions that come from members of the Eurozone itself. For example, there's some conflicts of interest. Some economies in the Mediterranean will prefer a certain, let's say, standard of the currency. Then you have others in Northern Europe who have a different view. Obviously, Germany has a different view, and so forth. So that's where the difference of opinions come. And actually, one of the weaknesses of the Eurozone experiment, although it's not a failed experiment for sure, and I will get to that in a minute, is that actually the Eurozone itself was supposed to be a staple of only a couple of members, the strongest economies in that specific group. Nonetheless, as the project continued to develop, it started to accept what we call academically less peripheral and less strong members into the Eurozone, for example, weaker economies. As such, as the Eurozone continued to expand, that's where some of the conflicts of interests and the criticisms came in, because of course, when you have so many different economies, so many different views, you have a level of bureaucracy that comes into it, which is why sometimes you hear some criticisms. Nonetheless, as a project itself, it's incredibly successful, not just for social integration. We're sitting in a region now which has spoken about a common currency, the Gulf currency, for a number of decades. It's never got off to a start. We have the same with the Asian currency, never got to a start. But the euro currency itself has now been incorporated for just over 2 decades. It was at some point looking like it was going to challenge the US dollar as the world reserve currency. Now it's settled as number 2. But in the modern age, considering the euro coin was actually developed late 1999, but it became into circulation in the early 2000s, for how that currency was able to develop and be incorporated into what has become a very big regional economy, that itself is very successful.
And how do investors react to political instability within economic blocs?
As a rule of thumb, investors do not like any type of uncertainty. And what I will do here is I'll bridge to a topic that is becoming very topical now in international news flow. Trump's policy, specifically with trade tariffs. Because it's not just about putting taxes on goods, and that's what tariffs are. You're adding an extra tax onto a product. It also relates to bilateral relations, political relations, diplomatic relations, and so forth. So let's look at some of the volatility we've seen in financial markets over the past 6 weeks. We've seen the types of swings in different asset classes, whether we're looking at equities, stocks, commodities, foreign exchange, that actually some of us haven't seen since the early weeks of COVID pandemic and that panic. So I would say, on a general rule of thumb, investors do not like uncertainty. Nonetheless, uncertainty in our line of work leads to a lot of opportunities for business. interest and trading activity and so forth. But of course, the purpose of such panels is to help provide client education and also awareness about what are risky and liquid assets.
Thank you so much, Mr. Jamil. Moving on to Mr. Yusuf. How do currency unions differ from free trade zones?
Good morning to all. Currency unions and free trade zones are very much they don't have much similarities, but they are interconnected. Like say, currency union are union of countries, they adopt for a unified currency, either in a formal or an informal way. See, the best example is the Eurozone, where 19 countries have come together to form a currency union. So all these 19 countries, they don't have their own fiscal or monetary policy, but they take euro as a common ground, as a common currency for all the trading needs and requirements. As far as when we go for the free trade zone, it is a trading agreement between the countries which involves the tariffs, customs, products, commodities, what to export, import, the quotas of the products. These things are narrowed down and made absolutely zero to the extent that the countries involved in the free trade agreement can transact freely without any hindrance. So this is the overview. Now the main difference in this comes in the monetary policy. In currency union, the currency is same for all the countries, whereas in free trade zone, the currencies are independent with each of the countries. They just have the trading pact, but not the currency conversion, like currency in common. Another thing is economic implementation. For currency union, it affects the economy as a whole. It's a deep integration into the economic value of a country. But in free trade zone, it doesn't matter, because you are just exchanging the goods and services at the prevailing market price in your own currency. So it doesn't affect anyone. In terms of economic crisis and instability, it affects the currency union much more, because all the countries are looped in as a one country, one currency. But in free trade zone, though that economic instability doesn't account for. If one nation is having some recession or say inflation or any sort of things, like even like a war, it will not affect all the members of the same federation. So these are some of the differences in both the sides. And the major thing is in the sovereignty, in currency union, the country often loses the sovereignty because there is no independent monetary board, no fiscal policies. But the same goes for free trade zone. They can have everything of their own at their own terms. And the best example, as I said, for currency union, it is the Eurozone. But as per the IMF, there are total 4 Eurozones as of now which are active. And for free trade zone, we can refer to the federations like NAFTA, which is now termed as USMCA, which is US, Mexico, and Canada. And there are many different small or bigger trade unions, like, trade zones, like CPEC, which is China-Pakistan Economic Corridor. That's it.
Amazing. And what are the financial risks of relying on a single regional currency?
Yeah, sure. A single regional currency brings in good benefits, synergies, but at the same time, it possesses many financial risks. The number one, the monetary policy of unified country may not be suitable for all the countries. Here, I would like to take an example of Eurozone, where 19 countries are a member of Eurozone, and they have the common currency euro. But do you think the economy of Germany and economy of Slovakia or Slovenia is same? No. It doesn't suit all member countries. It is different to different. So that is the risk. Secondly, if any country having the economic slowdown, which is inflation or recession, they cannot change their interest rates, they cannot overshoot the demand or supply for the currencies because it is centrally governed and controlled. So this is again a major risk. The third is in terms of development. We can say all the countries inside the union don't have the same development. Many countries have the GDP over and above. Let's say in the Eurozone itself, Germany accounts for more than 35%. So the cost of living or the GDP of Germany is much, much higher compared to other Eurozones. So it is draining out the, pulling out the euro on the Germany side. But other nations don't get the equal share in that way. So these are a few of the things, the underlying financial risk. And in terms of, let's say, weaker nations, because all the nations share the same currency, if there is a more developed opportunity coming up in other nations, the weaker nations, the funds will move out from the weaker nations to the developing nations. That will again give a financial crunch to the countries. And all the major financial risk what is there is the banking risk. All the banks under the SEPA are interconnected, and any default in the major country can lead to a catastrophic event, because it will lead and affect all the member nations due to the event. Thank you.
Thank you so much, Mr. Yusuf. Moving on to Mr. Fadi. In your opinion, what are the major economic blocks emerging in 2025?
Is it? All right. Good morning, everyone. Looking at 2025, I guess we are developing, actually. We are at the stage we are developing some of the major challenges for the next at least 3 years, where Trump will be facing us for the next 3 years at least. And I mean by that, the upcoming period is going to be labeled by time lag. See, time lag is basically a term in economy, in finance, and it means the time that any action that needs to be reflected in the economy. Meaning, at the moment, not Trump administration, not even the Fed, no one exactly understand exactly what is the impact of the recent policies. Excuse me, stop talking. I can see you. So I can see that. I'm just kidding, by the way, you know. So basically, so the recent policies have been made by the Trump administration. It needs some time in order to understand what is the impact. That's why Jerome Powell, he doesn't really react based on any pressure that comes from the Trump administration or anything to continue the lowering the interest rate. The Fed, as a central bank, they react to the action based on what's going on in the economy. Therefore, they need this time, which is called the time lag, in order to understand how this will impact the economy, and then we react to it. Why is that? Because if, for example, Jerome Powell agrees to proceed with lowering the interest rates from here, and thereafter, within 1 to 2 quarters, then we see that there is a spike in the inflation caused by the recent policies made by the Trump administration. Then, very shortly, Jerome Powell will have to shock the market. How he will shock the market? Because he's going to stop lowering the interest rate, keeping the interest rates higher for lower, and might be, if the spike in the inflation was really high, might have to go back in order to increase the interest rates, tightening, changing that policies. The policy that is going on at the moment by the Fed, by the way, it's called quantitative easing in the economy. So to shift from quantitative easing to tightening, then there is a big shift. That's why they would never take this risk. That's number uno. Number dos is basically the geopolitical that we have, the challenges that we have. and we had the most in 2024, 2023. At the moment, we can see that the gold is reacting to basically the ease of the geopolitical challenge. But thereafter, in the second half of the year, we still have Russia and Ukraine not solved. We still have the major conflict in the Middle East not solved. And the most important thing, we still have not solved the issue between the tariffs between the United States and the China. Because if you go back, even what have been made, like the reaction, the very positive reaction that have been made this week, if you go back to the statement, China and the United States, they both agree to pause first of all, to lower the interest rate to 15% and to pause it for 90 days. Then the main question remains, what about after the 90 days? What's going to happen?
Okay, and how do investors react to political instability within economic blocs?
This is a very important thing. Now, in order to understand the difference between the different kind of investors, we need to understand basically the financial behavior of the different investors. So basically we have retail investors, which basically doesn't represent more than 5% of the entire market. The entire market is basically moved by institutional, by government, and by funds for sure. And thereafter then, I don't think even the surge in the major US indices, NASDAQ, Dow Jones, S&P, even Russell 2000, I don't think this would be sustainable, and this would be actually a sign to start buying for a new bull market, except till the uncertainty in the market is gone. That's why the retail investors, they might act now. But if you're looking at the institutional, and by the way, I would advise you, it won't take more than 2 minutes from you. Stop talking again, come on. Jesus Christ, just kidding again. I would advise you to go and take a look at a report that goes every week about the inflows in the market. You can see the inflows and the outflows. If you see that there is, and you have to go back to the months, which actually, again, takes a few minutes. When you see that there is inflows, real inflows from the institution, that's the actual sign that the market is going to have a pump, which didn't happen so far. Therefore, I would say the major thing for the investors is basically to wait till there is the uncertainty that we have in the market, at least to ease.
Thank you so much, Fadi. Moving on to Mr. Yannis. As a policy advisor, how would you recommend strengthening regional financial cooperation while managing sovereign risks?
So first of all, we need to understand that when countries will enter into any kind of agreement, there is a commitment, and there is a future, and there is something that is beneficial. This is the first part. When you actually commit to a specific, especially on country level, where you have the agreements where we saw, for example, with the UK, that although the Brexit took place, there were still discussions for many, many years about backstops and free zones and so on and so forth. It's not so easy to exit a deal. So what is important in these cases is to have the people that, not the people that understand the local economies, like the local central banks or the ministers of finance. You need to have the people, you need to have a body that is going to supervise on a technocratic level all the countries. The people that they will not care if someone is Cypriot or English and so on and so forth, but they will care about what is happening on European level, that they will be able to take the plus and minuses of Germany, the plus and minuses of Greece or Cyprus or any other country, and just try to find a common ground. You need the average. If there is not someone that can create the average, the policies will never manage to be in place. So the first thing is for people that they actually understand the big picture, to be able to make decisions, to give the free pass to these people to take their opinion, to sit everybody together coming from different countries, of course, and different background, to manage to get the average, and then when they get the average, actually enforce without any opinion, without allowing any countries to have their own opinion, to enforce the result of their research. And that should be the way that people should manage their common ground or their agreements.
How do currency unions differ from free trade zones?
Well, currency union, it's a wedding. A free trade zone, it's a relationship. When you make a free trade zone, people benefit. So I produce potatoes, you produce oil, I bring my potatoes to you, I take the oil from you. So it's beneficial in terms of strengthening the economy. In terms of unions of currency, yes, the individual countries lose their own saying, but for example, in the case of euro was not enforced in the first group of countries when the euro was created. They had to choose if they will whether they will keep their local currencies or if they will accept the euros. The countries that entered the eurozone beyond that point, they didn't have the option. But those countries, they knew what the eurozone was. They knew the benefits, the advantages and disadvantages of having the euro. Euro is a commitment that nobody can back out from. It's not possible. Nobody can imagine any European country operating without the euro. And even if, for example, yes, countries lose their saying and they are not so flexible in applying their own policy anymore, we need to accept the benefits of euro. For example, when it comes to imports, because you have a different exchange rate and you have bigger orders that actually are beneficial for the Europeans to buy goods from third countries. So, for example, now that European Union is trying to buy medicines on European level or to buy new weapons on European level. So we cannot just say that there are disadvantages because we lose our own opinion. We have to be able to also accept the benefits of having the euro and just to accept that we are going to lose some of our liberty, some of our own saying for the greater good.
Thank you so much, Mr. Yannis. Moving on to Mr. James. How can regional infrastructure projects influence investor confidence?
Hello, everybody. So, with regards to regional infrastructure projects, they're key for the markets to ascertain the vision of the region or the country. If we're talking about things like telecommunications, roads, anything else that helps the infrastructure and the logistics of a country to do business, that's going to benefit the country as a whole and increase consumer confidence or investor confidence. But it's very much dependent on the execution of these projects. So, for example, if we look at developing economies or developing regions, quite often we see significant corruption in these regions. That can have a negative impact on the consensus or the perception of the country as an investable country. I think there's a number of examples in Africa. There was a railway solution, a gorge railway in Kenya that was largely funded by the Chinese fairly recently, and everyone was super excited. On paper it was a game changer, but it was marred by corruption, opaque contracts, bad execution, and subsequently confidence in Kenya as a developing region dropped. So, investors looking at Kenya as an area that potentially they could invest in the infrastructure were subsequently put off by it. So it's very much dependent on the execution of the project, and that pretty much depends on any corruption, the contracts that are in place, and the actual execution of it in a timely way. So kind of sticking to deadlines, etc. So it's it's obviously the impact is massive potentially. If you're looking at places like Ethiopia, they've taken on some other projects which unfortunately haven't been super successful, and subsequently investor confidence has dropped which will ultimately impact the economy and slow their growth.
Okay, what are the financial risks of relying on a single regional currency?
So I think the obvious example to give here would be the Eurozone. And I'm sure people see the pros and the cons of the euro as a single currency across a region. But there are multiple risks. So asymmetric risks, for example, the impact on a certain country on the back of a banking crisis, a housing crash, or a recession will vary from country to country. So you can't compare, as one of my peers said, Slovenia with Germany. One size does not fit all. In the 2008 crisis, what we saw was Greece was heavily impacted by a recession that lasted for a long, long time. And then you had contagion as well. So countries like Spain, countries like Italy, because they were similar to Greece, they fell into a similar category. They weren't in a position where they could devalue their currency or reduce interest rates, and so the recovery took far longer. So you've got asymmetric risk, contagion, and lack of sovereignty. So, again, you don't actually have control over your currency. You don't control how you deploy, your funds. I mean, if you look at the ECB, in theory, the EU or the ECB would have been a fantastic project, but it's evolved into something which, being from London, having lived in Europe for most of my life, I've kind of seen firsthand the impact of the EU on the globe, across the world, and particularly in Europe. And for the most part, it's an unelected dictatorship. You've got a lot of people who weren't voted into power making decisions on behalf of an entire union from Brussels. And again, maybe you have a seat at the table. Obviously we left the euro, right? We have Brexit. I think the large reason behind that was because there was no autonomy. We didn't have the opportunity to call a veto on some of the policies that were being played, even though we were one of two contributors to the EU. So you kind of look at it and you think, well, yeah, it's important to have a seat at the table, but if you don't have a voice, then what's the point? But look, I like to think that the EU can recover and kind of get their policies back on track, but there are significant risks, as you'd expect.
Thank you so much, James. And thank you to all our esteemed panelists. Thank you for being with us here today. It's a pleasure to have you. And it's really conversations like this that keep us to stay ahead. Thank you so much and enjoy your day.